Hello, everyone. My name is Sam Stovall, and I'm the Chief Investment Strategist at CFRA Research. Today's presentation is titled Taper Tantrum or Takeoff. Let's go to the next slide to let you know who we are, and if you want to learn more about what this presentation is all about, as well as the research that we offer, please go to CFRAresearch.com. That way you get to learn about our wealth management research, our forensic accounting research, our technical analysis, and our recently acquired political analysis. Also, we're offering free trials to at least our technical research and our wealth management research. So please go to CFRAresearch.com to learn more about CFRA and its services. Let's go to the next slide. We can see what the agenda is for today. We're going to talk quickly about post-pullback performances. We just concluded a decline of 5.2% and now are notching several new highs along the way. What are some of the encouraging factors behind these new highs? We will focus on the fundamentals, whether it be economic growth, earnings, as well as our outlook for interest rates and inflation. Plus, investors are worried, are we going to have another taper tantrum? Or have we already had that and now we have an opportunity for stock prices to take off? Then we're going to come up with some actionable idea, introduce you to the industry momentum portfolio, as well as the nervous Nelly portfolio. And then David Holt will take over and start talking about our stock-oriented portfolios found in the intrinsic value and high-quality capital appreciation. So let's get started. We just went through a decline of 5.2%. And as we see in slide 4, it was actually a decline that was long overdue. It was the 9th longest period going back to World War II between declines of 5% or more. We had gone 293 calendar days versus the average of 104 between each pullback, correction, or bear market. Pullback being a 5 to 10% decline, correction being 10 to 20, and bear markets being 20% or more. So we had gone 293 days. We had amassed a gain of more than 37%. So it was due for a decline, which we had. And then we got back to break even on October 21st. So now the question is, have we heard the all clear signal? Well, let's go to the next slide, because that's one of several things that I like to look at is breadth. There's always leadership in the market, but it's the breadth, if you will. It's, you can have the generals out in the field, but unless you have the troops along with you, you're not going to be able to stand for very long. So these two charts are showing the percentage of the 147 sub-industries in the S&P 1500, which consists of the large cap 500, mid cap 400, small cap 600, that are trading above their moving averages. We had gotten below one standard deviation from the mean in the top graph on a rolling 10-week or 50-day moving average basis. But through last night, October 25th, we had 71% of the sub-industries trading above their 50-day moving average versus the average of 59%, looking at all weeks or all months going back to 1995. The bottom chart shows on a weekly basis, which is similar to the 200-day moving average, that now 75% of these sub-industries are trading above their 40-week moving average, also above their long-term average of 64%. So breadth would indicate that, yes, we are out of this correction and that we're likely to see higher prices. Let's go to the next slide, because humans by nature like to categorize things. And as I mentioned, we've had pullbacks, corrections, and bear markets. Well, in terms of a count, going back to World War II, in bull markets, we have had now 61 of these 5 to 10% declines, 23 of them, of the declines being 10 to 20%. What's most of interest, however, is the speed with which it takes to get back to break even. It normally takes 36 days or about 1 month to go from peak to trough. but only about a month and a half to get back to break even. Even with declines of 10 to 20%, it takes an average of less than 4 months to get back to break even. But I shaded in blue the top line because history then says after getting back to break even, following a decline of 5% to 10%, the S&P 500 rose an additional 8.4% on average over the coming 98 calendar days before falling into another decline of 5% or more. So that certainly would put us into 2022 before we are likely to see another decline of 5% or more. Granted, these are averages, and there's always the possibility that things could come around more quickly, but this is just one of the indicators that implies that we still have time to go in this post-pullback rally. Let's take a look at the next slide, which shows many of the market milestones that we have experienced thus far this year that imply a favorable second half and, more important, fourth quarter. We had 10 or more new highs through February 28th. For the full year, the average change was 15.7%, and the FOA, or frequency of advance, was 91%. So meaning in those years in which we had 10 new highs through just the first 2 months of the year, the S&P was up strongly at 15.7 versus a long-term average of only 9.0, as we see in the very bottom row. And instead of getting a more normal 74% frequency of advance, we got 91%. But it wasn't expired, and if you will, we didn't use up all of our fuel early in the year, because the second half also ended up being pretty strong, up 4.9%, rising 73% of the time versus the average 4.5 and 70%. And then lastly, fourth quarter, you see that a majority of the second half gain occurs in the fourth quarter. The last one, October low through year-end close, I just recently added because we had our low earlier this month. And going back to World War II, we have found that the average price change from the October low through the year-end close has been a gain of 7.2%. and a frequency of advance of 92% of the calendar years since World War II had a positive return. So taken all together, the average gain 4.7%, frequency of advance at 83% implies, but obviously does not guarantee, that we could end up with pretty positive performances in these final weeks of the year. Let's go to the next slide to show from a fundamental perspective why we could still feel encouraged. This is economic growth projections for 2021 and 2022. So we had the drop in 2020, we have the pop in 2021, and looking for continuation of economic growth into 2022. I'm showing the two groupings of numbers because we have had reductions to third quarter estimates, and as a result of that, full year numbers have come down slightly. We see that while global GDP growth is still expected to be at about 5.5% for 2021, we saw a reduction for the advanced economies, but an improvement in the emerging economies. US expectations are now at about 5.6% versus 6.1% at the end of the third quarter. And then you can also see what the outlook is for the Euro area, Japan, and China. And also you can see that expectations are for continued growth in 2022 with just some minor downward revisions. So the optimism is still out there for economic growth to be retained in the coming calendar year. Obviously, if we have good economic growth, that implies favorably toward earnings growth. So as we see in slide 9, looking beyond the earnings valley, what we see is the blue bars showing what happened in 2020 for the S&P 500, the Developed International Index, and the Emerging Market Index. We see in the gray bars what the earnings forecast is for 2021, and then orange showing expectations for 2022. So obviously, when we're coming off of such a horrible 2020, it makes 2021 percent changes look that much stronger. But then again, we're still looking at above average performances in earnings growth expected for the coming calendar year as well. So if we take a look at the next slide, we can sort of dig a little bit deeper at looking at some of the expectations. First off, we show that our 12-month target for the S&P 500 is 4870. We are looking for earnings growth to break above the $200 per share level this year, and then start to challenge the $220 per share level next year. Revenue should be up 14% this year, a little more than 6.5% next year. But GDP growth, as I showed earlier, about 5.5% this year, 4.5% next year. Inflation, yes, it is a concern, and maybe you could call it transitory, but at least with a lowercase t, because our expectation is that December should be showing the highest year-on-year percent change in headline CPI, and in this case, also looking at core PCE. But then we're looking for a reduction in year-on-year changes in these inflationary indicators to less than half at 2.2% for all of 2022. So yes, inflation is expected to be higher than what we have seen in the past several years, but still we're expecting it to come down quite a bit 1 year from now. Fed funds rate averaging still the between 0 and 0.25 this year. We are expecting to see possibly a pickup in that in 2022, because our belief is we probably could see the first rate increase take place in the fourth quarter of 2022. 10-year note obviously will then be averaging higher over the coming calendar year. This higher interest rate will probably make our fixed income more attractive on a global basis, so that should help improve the value of the US dollar. And also WTI oil prices are expected to continue to work their way higher in the year ahead, and probably eclipse the $90 per barrel level sometime starting in the second half of 2022. Our economists are predicting that we're probably not going to be spiking to $100 per barrel anytime soon, but the longer term trajectory is certainly higher. But that leads to the question, if the Fed is likely to stop its tapering, or will taper its bond buying program starting in either November or December of this year, and then concluding by next summer. And many investors have said, well, gee, are we going to experience a taper tantrum? Well, if we take a look at the next slide, you might say we've already experienced it, because in 2013, this box shows on the left-hand side all of the sizes, styles, and sectors within the S&P 1500 index. I also threw in the iShares 7 to 10 year Treasury bond ETF. But in here, we show that the S&P 500 declined only 5.8% from May 21st of 2013, when Ben Bernanke let it slip at a congressional hearing that the Fed would likely start to taper their bond buying program should economic growth continue to improve. But this tantrum only lasted about a month. By June 24th, the tantrum had ended. The market was down less than 6%, even though we did see a lot of sectors, styles, and sub-industries in the red. This really was a short-lived pullback. So now the question is, well, what happened following that? What happened after the taper tantrum? Let's go to slide 12, and we can see a similar grouping of styles, sizes, sectors, and sub-industries that post 2013 taper tantrum, meaning from June 24th through the end of the calendar year, the S&P 500 was up 17.5%. We had sector performances as little as 1.7% for the old telecommunications, up to almost 26% growth for industrials. We also saw that 98% of the sub-industries in the S&P 1500 were in positive territory. The assumption being that if the Fed felt that they could start to reduce their bond buying program, then the economy was strong enough to handle the tapering, and at the same time, probably to push earnings higher and therefore share prices higher. So let's take a look at the next slide to see, well, what happened to the market when we were actually going through the tapering, not just talking about the tapering, but actually going through the tapering. Well, that occurred from December 18th of 2013 through October 31st of 2014. And we see that the S&P 500 gained an additional 15.7%. All sectors were styles and sizes posted advances, and 89% of the sub-industries in the S&P 1500 were in positive territory as well. So one could therefore conclude that if we are in the beginning throes of a tapering period, that maybe we could also be seeing positive returns going forward because the economy is strong enough to withstand the tapering. Also, we've seen many stock market milestones, whether it's the seasonal optimism that we traditionally experience in the middle of October through the end of December. It's the post pullback return for the market, etc. So possibly we are going to be looking for some good numbers, at least into the summertime of 2022. So where do we stand right now? Where is the strength within the overall market? Let's take a look at the next slide. And what I do here is I show on a rolling 40-week basis, which is equivalent to the 200-day moving average for these benchmarks, and these benchmarks being the S&P 500, mid-cap 400, small-cap 600, European 350, and Asia Pacific markets, the sectors within those benchmarks. And I highlight in green the 4 sectors that are in the top performance based on their 40-week look back. The white 0 is neutral, and then the red dash is negative. Now, is this helpful in terms of making sector predictions going forward? Well, historically it has, and so the implication is it might continue to do that. If you look at the box on the bottom, you'll see the 3-year compound annual growth rates. Every month, at the end of each month, if you look back over that 40-week period and you say, okay, I'm going to buy in equal proportions those 4 sectors that are leaders, I will then hold on to them until the end of next month and then do a 40-week look back and so forth. Ditto for those in the bottom 4. And what you find is that over the past 3 years, the compound annual growth rate for the top 4 sectors was 22.4% versus 19% for the benchmark versus 8.7% for the bottom 4 sectors. So let your winners ride, but cut your losers short. The trend is your friend until it ends. And this shows across the globe that energy and financials are consistent outperformers. Here in the US, you can add real estate as well as communication services. Across the globe, consumer staples are pretty much underperformers, ditto for healthcare and utilities. So it gives you an idea of which sectors are doing well or poorly, which then leads quite nicely into one of the 4 portfolios for which CFRA offers either ETF or individual stock recommendations to Peak that it uses to develop these different portfolios. So if we take a look at slide 15, you'll see that right now, those groups that there are right now about 20 industry ETFs available to investors. What we do is we let our winners ride. We select those top 5 industry ETFs based on trailing price performance. And those 5, we hold equal proportions, 20% into each, and then we reevaluate every month. So this table shows on the left-hand side, shaded in green, the 5 strongest industry ETFs at this point. On the far right-hand side in red, we find the 5 weakest, and then in the middle, we find the remainder that are either going to go high or low at some point down the road. If we take a look at the next slide, we see our nervous Nelly portfolio. where the intent of this is to encourage those investors who might be too nervous to invest globally otherwise. Here is a portfolio that instead of being in the overall benchmark, you are in the low volatility subsets of each one of these benchmarks. Knowing that you have to go to the amusement park to have fun, same with investing, you should be in equities in order to outpace taxes and inflation over the long haul. But in this case, instead of being on the roller coaster, it actually implies that you can be in the merry-go-round and still benefit from equity exposure. So the Nervous Nelly portfolio has a 40% allocation to the S&P 500 low volatility, 20% to mid cap, 10% to small cap, and then 20 and 10 for developed, international, and emerging markets respectively. And in the next slide, you can get an idea of how well these portfolios have performed. I shaded in blue the industry ETF momentum, as well as the Nervous Nelly, because I don't want to steal any of David Holt's thunder. But here it shows the month to date, quarter to date, year to date, and 12 months. And for instance, the industry ETF momentum portfolio, 12 months up 48.3%. Compare that with the S&P 500 or the equal weight 500, and you see a nice level of outperformance. Nervous Nelly up 19.9 versus the MSCI All Country World Index minimum volatility, and you see that outperformance was there as well. So in summary, as we see on slide 18, I believe that the market certainly has entered in a seasonal sweet spot, and history does indicate that the market tends to go up more than 7%, more than 90% of the time in this 10-week period. I think that rising GDP and earnings estimates will continue to offer encouragement. We will be seeing increases in concern regarding inflation and interest rates, which could pose as a bit of a headwind. But as we all know, the market does like to climb a wall of worry. Traditionally, cyclical sectors have performed better during periods of rising inflation. So areas like energy, like industrials, like materials, and if we have a steepening yield curve, financials tend to do fairly well. And along the way, corrections are inevitable. Use stock market history as virtual Valium because it will help calm your nerves by focusing more on the recovery time than on the time of decline. So with that, I'll stop out adding hot air to this webinar and turn it over to my colleague, David Holt.
Hey, thanks, Sam, for the handoff, and thanks to you all for tuning in. So by the time we actually cycle through this section, I hope you have a better idea of really how model portfolios work and how we think CFRA and P Capital can actually step in, work together, and really help you achieve your goals. So first with slide 20, if you've tuned into any of the other webcasts that we've had so far in 2021, you've probably seen this slide that we really think helps illustrate the varying risk appetite for investors and what we think are key inputs driving market sentiment currently. So by now you've probably heard everyone's take on the timeline of when to expect a tighter monetary or fiscal policy and what drives each of those scenarios. So I'll try to come about this with a different approach and really marry that rising rate environment and the current market conditions and what we're seeing on the ground, so to speak. So in our opinion, you've seen investor risk appetites actually edge down as the general shift from lower quality to higher quality stocks. You can kind of see the movement to some extent. In turn, you've also seen the demand for income yields actually rise as investors try to counter any sort of inflationary pressure going forward. And then also, when you kind of step back and assess this and the overall market backdrop and some of the large consecutive gains that you've had in the past couple of years, I think it's really only prudent to take this into perspective in terms of kind of your medium-term portfolio positioning after that 10-week period that Sam actually alluded to into 2022. So now moving to slide 21, I thought it might be good to actually go back to the basics here and just give a brief rundown of some portfolios and how we think these operate most efficiently. So first, we have high quality capital appreciation. So for this portfolio, The objective is to really buy some of the best companies at the best prices, get paid to wait, and then sell them when they get too expensive. And then you rinse and repeat that process. So a general rundown is the strategy itself has actually been around since 2003, and it's one of 6 actively managed portfolios specifically geared towards stocks that we have currently. On the bottom left here, you have some of the characteristics that you can see in the portfolio, which is concentrated with only 15 names currently, and we currently have a market cap of around 450 billion. So it is large cap focused. And I would also say that when you span over to the risk characteristics on the right-hand side, it is for your risk-adverse investor. So with a beta of around 0.83 of the total market. It's also attached to a pretty healthy dividend yield that's somewhat in line with the S&P 500 of around 1.3 to 1.4%. So transitioning here to slide 22, and this is just to sum up really how we identify names that could make a good fit for the high quality capital appreciation portfolio. So I think really the name kind of sums it up well, but what exactly does that mean? So to us, we look for names that really offer that longer term capital appreciation, but with a good balance of risk and reward. So companies with durable earnings and cash flow profiles, sound balance sheets, or some kind of sustainable competitive advantage in their business model. Also, I think I'd be remiss if I didn't actually mention that we actually hone in on management teams as well. I think that companies that can actually underpromise and overdeliver on a longer term purview really are ideal candidates for this specific portfolio. So you can see some of the highlights with the gray on the right hand side of this chart of really what we look for. And with the funnel itself, we lay out some of the actual key screening criteria as well. So we use quality rankings, and that's really the first step to really capture some of those higher quality names that you can see at the top left of this funnel. So that serves more so as a guide for durability of earnings and dividends, and that's more so from a 10-year look-back period. From there, we really lean on both the fundamental and forensic analysis teams to really help ensure that we bring the best possible options to our portfolio committee to actually vote on. So we'll start with 60 companies and filter down to 1 or 2, have those voted on, and entry of the one that actually wins to the portfolio. All right, so moving to slide 23. So here we'll actually switch gears to a different strategy with intrinsic value, which has a storied history as well and dates back to about 1995. So the biggest takeaway with this strategy is it is a quantitative rules-based portfolio that we actually revisit and rebalance twice per year in March and September. So that's where most of these names are being added or removed based on the specific investment criteria that is actually generated from our quantitative team. So the number of holdings usually hovers around 50 to 60 names, but it's been as high as 90. And it really just depends on how many names meet that specified criteria that we screened for. So we recently undertook the September rebalance, where we saw the biggest increase in sector weightings in tech and consumer staples. So some of those notable adds were Netflix, Intuit, and Procter & Gamble. So on to slide 24. I like this slide because it really helps call out the key factors and how names actually qualify for entry into the intrinsic value portfolio. So building off the prior slide around the September rebalance, the total count of names have actually stayed relatively flat at about 84 currently. And that's comprised of 68 existing companies and then 16 newly added names. So from, I would say, a fundamental perspective, I'd also highlight that I would say the key gating factor of what we think makes this portfolio attractive is the screening criteria itself and how it's purpose built on more so to find companies that have an efficient way of deploying capital and generating a return on that capital or return on invested capital that's above a weighted average cost of capital. And that can actually be indirectly gauged with multiple levels of this screen, as you can see kind of highlighted in orange with net profit margins as well as retained earnings. So now on slide 25, I think the title here really sums it up well: secular with a defensive undertone. And as you can see from kind of the sector weights for each portfolio, the purpose of this slide is to really try and overlay with how funds have been recently allocated versus how both portfolios are currently positioned. So currently both portfolios have some visible similarities with a tilt towards more so defensive names in healthcare, staples, or larger cap technology. Given we actually try to stay true to a longer term outlook, we try to keep the churn low on both portfolios and really avoid short-term calls or trades and let the long-term fundamentals drive the decision making. So turning to slide 26, this specific slide really ties into what I dove into with risk curve that we had on slide 20. So we've updated this for September quarter to really illustrate how visible the move has been back to higher quality names from lower quality names. So to really rejog everyone's memory again, we took the entire universe of S&P Capital quality rankings, which came out to about 1,100 names, and grouped them into two different buckets, whether they be higher quality, A- or better, or low quality, B+ or below. And that's in regards to price performance. So you can really see the large outperformance from the beginning of the year from those lower quality stocks as kind of that dash to trash, came about, and how higher quality names have now officially taken over leadership in September quarter. So you've seen the steep gap up to the sharp gap down, where the defensive names have actually shined during the recent lull that we've had over the past couple of months. And then when you pivot over here to slide 27, and this more so dovetails from the previous slide, performance is really largely low quality to high quality dynamic. So although we're still down year to date, the portfolio has actually taken back leadership and really started to outpace its benchmark as of September quarter and last month. So lastly, spanning here to slide 28, again, a similar theme to high quality capital appreciation. That's where solid long-term outperformance has been recently overshadowed, I would say, to a short-term underperformance, which we've actually called out in the red boxes here. But hopefully that can continue to shift as we kind of move to a more income-oriented environment into the back half of 2022. That really wraps it up on my end. I really hope this was helpful, and I'll pass it back to Quinn to close up the call.
Sam and David, thank you so much for sharing your insight with us today. As we at Peak Capital speak with advisors across the country, they're asking us one question: where do we go from here? With major indices continuously hitting new record highs, fears of inflation, and supply chain concerns, advisors and their clients are on that edge given the uncertainty of what is next to come. However, while we might not know what the future holds, we do know that a rules-based, disciplined approach to investing can assist in mitigating risk while seeking consistent returns over time. Peak Capital Management has the honor of making CFRA's research available to advisors and their clients as managed solutions through managed account platforms. If you'd like to learn more about how to access those strategies, which leverage CFRA's research and best thinking, please do not hesitate to contact me direct via phone or email with my contact listed on this slide. As we move forward to the disclosure slides, I will close things out for this quarter's WebEx. Again, Sam and David, thank you for your time and really appreciate our partnership. We will continue to look forward to serving the advisor community with you at your team at CFRA. Until next time, take care, everyone.